Hi, my name is Khurram. I'm just going to show you a brief outline of a CIR, corporate interest restrictions. Um, this is useful for people who are doing CTA, TOMC paper or ADIT 2.09 paper, or otherwise someone wants to understand the corporate interest restrictions rules. So I'm not going to go into a greater detail because there's quite a lot of things you need to remember, but it's just like a brief outline how the CIR work, why do we do CIR, and it's what are the developments in BEPS plans. So first of all, what is CIR? So obviously CIR means corporate interest restriction. And CIR is a new regime which is in place after BEPS Action Plan 4 talks about CIR. All right. So why there is a need for this kind of rules? So as a brief outline, if a one company, which is a multinational enterprises, if it wants to set up a new company in another jurisdiction, they have two different forms of investments. So say for example, if it's a US entity, it wants to set up a UK entity. So US entity can sponsor UK entities activities either by subscribing shares or giving loan. If US entity gives loans, then it can charge interest. And if it subscribes shares, then it will pay dividend. UK entity will pay dividend to US entity. Now, if UK entity pays dividend to US entity, that's not tax deductible, so you cannot deduct the expense as a deductible expense in your computation, tax computation, not tax deductible. However, if US entity gives loans to UK entity, then UK entity can pay interest on that loan, and that interest is tax deductible expense. So now if you can see, if the US entity gives more loan, then there will be a deductible expense. And in other words, you will say that UK entity will have less amount of profit to be taxable in UK. So it's more beneficial for UK entity to claim interest deduction rather than giving dividends. Therefore, lots of multinational enterprises go for loan notes. So therefore, HMRC does not encourage that you should have a lot of loans instead of shares. Therefore, they give, there's one term called thin capitalization. Yeah, so the companies must not need to be thinly capitalized. There should be a balance between shares and loans. So it doesn't mean that you cannot go for a loan. You can go for a loan, but not more than your share subscription. So sometime, although it's not a thumb rule, but it's like a safe harbor, as long as you are 1:1 ratio between equity and debt, that's kind of acceptable. However, even then, there was a lot of debate that because more economic activity is being taken place in UK entity, therefore UK economy has more rights as compared to US economy. Therefore, now there is a consensus under BEPS plan. They have devised that there are, when the loan are kind of too much as compared to their foreign loans, right? Then there should be some specific deduction. Up to that level, they should not deduct any kind of interest, regardless, even if it's at an arm length. So this BEPS action plan for corporate interest restriction addresses that. So previously there was another rules called worldwide debt cap. There used to be different calculation, so that has been abolished, and now we need to calculate how much amount of interest is allowable in terms of corporate interest, how much overall interest expenses allowable. So I'm going to give you a brief background or like a quick overview that what are the things which you need to look for, how do you calculate this. So this is like a um, equations wise, right? So first of all, what we are aiming to do is we want to restrict the interest expense in a company. So just a brief outline. So if we see a P&L of a company, we will have revenue, we will have cost of sales, we will have operating profit, and then there will be admin expense, and then there will be a, that was gross profit, that will be operating profit, and then there will be a finance cost, and then this will be profit before tax. Okay, now we are basically aiming to restrict this amount. So how much is a restriction amount? So BEPS action plan 4 divided, there is a de minimis limit. So as long as the finance cost is up to certain level, you don't need to restrict that. If it is more than that, then you go for a restriction. And that certain level or threshold is 2 million. So first of all, what I would say, what I would say is that first equation is how much is total disallowance? How much is total disallowance? So we would say this triangle in mathematical figure. Disallowance is equal to your total NT. I'm going to tell you about these notation later on. So overall, your total NT minus interest capacity. So what is your interest capacity? You deduct from overall total interest. NT is aggregate net tax interest expense. What exactly it is, I will tell you later on. So whatever your interest expense is, minus your interest capacity, how much you are allowed to use it, that is the disallowed amount. Now, what is interest capacity? Interest capacity is higher of total interest allowance or 2 million. Yeah. So either your total interest allowance, which is higher than 2 million, then this would be the allowed interest capacity. Or if your total interest allowance is lower than 2 million, then 2 million is your de minimis limit. So higher of total interest allowance and 2 million. So now what is total interest allowance? In total interest allowance is your interest allowance plus brought forward interest allowance. Okay. So brought forward interest allowance is that you had an interest allowance last year and you haven't used it, and then you have to carry it forward. So there is a separate calculation for that. This is not covered in this session. So it's just like overview of the all equations. Yeah. So most of the time, if someone is some group of companies are subject to CIR, they will hardly have interest brought forward interest allowance because they always will have interest expense higher than their allowed amount. So brought forward may not be always the case. Yeah. Now, what is interest allowance? The interest allowance is basic interest allowance plus NT with I. So if you are aggregate net tax interest income, if there is not any expense, so then that plus basic interest allowance. Now, what is basic interest allowance? Now, basic interest allowance can be calculated in two different forms. One is fixed ratio method, and the other is group ratio method. So why is that been used? That there is some rationale behind it, but that's kind of, I will tell you, or maybe it's more than this video will become too big. So let's skip that point. But at the moment, basic interest allowance can be calculated in two different ways. So one is under fixed ratio method. It will be a lower of 30% tax EBITDA or your NG. Okay. Second way is under group ratio method, it will be lower of your V percentage multiplied by tax EBITDA or QNG. Yeah. Now, what is V percentage? V percentage is your total QNG over your group EBITDA. Group EBITDA. So now, with this equation, you will get a V percentage, you add this V percent to here, calculate, multiply with the tax EBITDA, that will give you the total allowed amount of basic interest allowance. Or if your QNG is lower than your V EBITDA, then QNG will be the amount which is your interest allowance. If you go through a fixed ratio method, then 30% straight away of your tax EBITDA is allowed as a basic interest allowance, or NG if it's lower than your tax EBITDA, then that will be the amount that is allowable as an interest allowance. Okay, and then you put this basic interest allowances here, and most probably NT will not be the case, then this will be neglected, and then that will become your interest allowance. Put that interest allowance into this implication in this equation, total interest allowance. So mostly highly unlikely that you'll have a BFIA, brought forward interest allowance. So then you put this figure into total interest allowance and then compare it with the 2 million. If it's more than 2 million, then this total interest allowance will be your interest capacity. Put that in here, and then your total NT minus this interest capacity will be your total disallowed amount in this current period. Okay, so that is quick overview of your CIR calculation. Although you will see in a chapter, it's kind of long, discursive. Obviously, you will understand with there, but this on one page you will understand whole CIR calculation. Now, I want to quickly catch up with the figures. What is NT? What is NG? What is tax EBITDA? What is QNG? And what's group EBITDA? Now, basically, let me tell you, as we have seen this, I showed you the PNL. Now, what the aim is, whenever banks give loans to the company, what are the basic criteria that how much are we going to give you? Whenever bank will give loan to a company, they will say, okay, I want, how much is your earning? How much your power to pay back our interest? So they look for two different equations. One is your overall earning, actual earning in the year. So your actual earning before tax, before depreciation, before amortization, yeah, and there are a couple of other things before management expense. Sometimes they say EBITDA M, so before management expenses. So how much is your earning capacity, so that we can compare? Okay, you are earning 10 pounds. Okay, so you can easily pay 2 pounds. All right. So they look for that equation. And secondly, how much is your equity versus debt ratio? Like, what's your leverage? How much is your equity is included in how much? So what exactly they want to know? They want to know the amount of interest and the rate of interest. They want to see the amount of interest, how much is it, and how much amount of loan you will have it. So if you look for that, the same principle, now HMRC and all the big taxing authorities have agreed that this is like a standard way of giving loans, or giving loan to some other entities. Group of companies should also follow the same principle. Therefore, they took all this idea and then put it into their legislation, and then to say, you follow the same principle. If you are a connected party, you're supposed not to give loan more than normally agreed by banks or something. So what they are looking for is that they are comparing the amount of loan and the rate of interest up to on this level. So this is a profit before tax. They will take out depreciation. They will take out amortization. They will take out interest expense in reality. Yeah. and some other tax adjustments. So if there are few expenses which are not allowed for tax purpose, they want to encounter this, they want to recognize this while calculating your EBITDA. Normally, this tax adjustment is not available when you are going for a bank loans. Yeah, but here they say we are not looking for only EBITDA, we are looking for tax EBITDA. When you say tax EBITDA, it's just like tax adjusted your profit chargeable to corporation tax. Yeah, so for that, all the tax adjustment you need to put it in. So there are lots of tax adjustment, and then there are a few which are like a management related to loan losses brought forward. If you have set it off, there are some R&D expense and some RDEC you have claimed on it, or some kind of income which is sheltered in a double tax treaty, double tax relief. Other than that, some losses brought forward, you have utilized it. Some management excess management expense you have brought it in, and then you have utilized those kind of things. Some balancing charge and balancing allowance related to capital allowance, if you have used those. So you take all of those kind of reliefs and income and expenses, and then look for hardcore earning of the business, hardcore earning coming from their business activities and investment activities. What is actual that earning? So that will give you a box of tax EBITDA. Okay, now they just say, okay, out of this box, I can give you two allowances. Either go for fixed ratio method and take a 30%, but if you think your interests are, so basically group ratio method is, as a overall, you just look for all the expenses of interest which you have from third party. So when you take the loan, as a, just consider, two connected parties can give loan as much as they want, but some third party, if they give the loan, they will give up to a certain level. Therefore, HMRC is not worried about those kind of loans. So then they say, okay, if you think your loans are like a third party loans, you can go for a group EBITDA calculation, and then you can get 30% of your group EBITDA. Yeah, QNG and group EBITDA is related to group level calculations. Yeah, so either you can go for a V%. Yeah, if your V% is higher than your fixed ratio method of 30%. Yeah, so that much is allowable expense. All right. Now I cover tax EBITDA. Now you understand that. Now what is NT? So basically, so first of all, tax EBITDA, it's related to only UK companies. Okay. So however, if you have about four group of companies or permanent establishment resident in UK, all those companies tax EBITDA, you calculate tax EBITDA of each company and then calculate it together. So all those entities which are subject to UK corporation tax, you have to calculate tax EBITDA and then aggregate it, and you will get a figure of aggregate tax EBITDA. All right. Now what is NT? So first of all, NT is related to aggregate net tax interest expense. Again, we are looking for only UK companies. Sorry for my handwriting. Yeah. So then you look for all the tax interest expense of a company. Say, for example, there are four companies. So you look for a tax interest expense of a company minus tax interest income of a company. That should give you net tax interest expense, right? So all the interest expense of each UK company, you put it here, take out all of its interest income, put it here, and then that will give you net tax interest expense of each company, right? So say, for example, if it's one company, UK company, only UK resident companies. So company 2, company 3, company 4. So you will take the figures, put it here, take the figures, put it here. All right. Right. So then if you calculate all of it, that will give you aggregate net tax interest expense. Okay. So this is how you will calculate. Now, one is the argument is that now what actual interest expenses and actual interest incomes are, you need to calculate. Now look at this way. In interest expense in UK, whatever is related to loans, they call it anything related to interest and stuff, they just say it falls under the regime called loan relationship. So there are lots of different types of expenses which are related to money, which you can put into a loan relationship regime. Those are calculated on the basis of loan relationship. Now, if those interests are trade related, you call it trading loan relationship. If those loans are related to non-trading activities, you call it non-trading loan relationship. Okay, so there are few expenses which are related to loans, but they are not hardcore money transfer. So for example, if there is any impairment of the, first of all, the tax treatment of all the loan relationship, 95% follows the accounting principle. So whatever you do for accounting purpose, for tax purpose, it will be the same treatment. If it's a debit in a P&L, for tax purpose, it will be a debit in P&L. If there is a credit in P&L, then for tax purpose, you will consider as if it's an income. Okay, so they follow normally accounting treatment. Now there are lots of expenses which are only for accounting purpose. So say for example, the movement of a loan, if there is a fair value movement of the loan relationship, you say the loan has been impaired. Yeah, so whatever the fair value was, it has been reduced from the fair value. So that impairment will be considered as an expense. So for normal tax purposes, that impairment is an allowable expense because we are following the accounting treatment. But when you calculate that tax interest expense and tax interest income, those kind of impairments are not an allowable interest expense or interest income. Yeah, that is not hardcore money which is companies paying. It just like accounting treatment. Similarly, if you think that there is a loan related to foreign currency, then the foreign exchange rate changes over the period of time, and therefore in your accounting in your accounts you will see lots of foreign exchange gains and foreign exchange losses depending on the movement of the currency. So that foreign exchange FX gains and losses you recognize in P&L. Again, this is also not a hardcore payment of a company. So basically in a CIR, we are looking only for those interest expenses which are UK companies are paying out of the UK economy. So these interest expenses related to impairment, related to foreign exchange losses, there are a few other hedges related to capital assets are also not disallowed, but that becomes too much. But at the moment, the key ones are impairments and foreign exchange gains and losses. These are not allowed to consider as a interest expense while calculating your tax interest income or expense. So normally when I will be calculating tax interest expense, I would take whole finance cost, or I would say finance cost, you call it, or you say total interest expense. So for example, in a schedule, normally I would get it, okay, X amount of tax interest expense, and then I will add back any expense related to FX losses, that this is not an expense. Yeah, so I would say no, here I won't, I will deduct it. So it's an interest expense, and then I would say deduct. Or the other way, you can say the foreign exchange total interest expense should be negative figure, then say add back. That will make life easy. So foreign exchange losses, I will put it here. Any impairment related to that foreign tax interest expense, I would put it here. And then that will give me a hardcore tax interest expense. Similarly, I will calculate tax interest income. All right, and then that would give me net tax interest expense of one company. So you calculate all of the 4 companies and aggregate it. That will be your NT figure. So now you understand NT figure. Now you understand tax EBITDA. What about NG? There is a long, detailed rules related to NG, but as a overall, in NT, you look for only UK companies. So up to this point, the one I said to you, you will get all this information from CT coms of UK companies. Yeah. If I look for a CT computation of one company, I can simply see their P&L. I can simply see their tax EBITDA. If someone is using alpha tax, is Schedule 2 normally. Schedule A gives you profit chargeable to corporation tax, but account adjustment section B1. Most of the time in computation, you will see account adjustment in B1 section. You will see how much is the total profit and what are the adjustments. That gives you a lot of information. And then you calculate tax EBITDA on the basis of P&L and that tax adjustment and PCTCT. And then there will be schedules for loan relationship, either trading loan relationship or a non-trading loan relationship. You may have different schedules in your CT computation on, and the detail of all the interest expense and income, you will get it from loan relationship. And then from there, I will calculate my NT. But in order to calculate NG, you need to look for a consolidated accounts, console accounts. Okay, when you say console accounts, so imagine if it's a US entity, have a multiple entities in UK and other Europe countries and some, let's say Middle East or something. So they will prepare their computation on, prepare their accounts on the basis of consolidated financial statement. And in consolidated financial, now look at this. When you prepare a consolidated financial statement, all the intercompany transactions, so whatever the transaction is between the connected parties, you net it off. You don't say it's an income from a connected company. So if there is a raw material cost £10 and is been given for £15, but where I received it from my connected company, that £5 profit, you have to take it out and then put it as if it's a raw material or something of £10. So meaning by all the connected party transactions have been netted off, and that will not form part of income or expense or assets and liabilities in a balance sheet. Therefore, imagine if there is a loan between two connected companies, if there is any interest on it, that will be net off. That interest will not be recognized in their balance sheet and P&L. Therefore, now you will see all the interest expense and interest income in a consolidated accounts, which is related to third party. There is no any connected party connected party elements in there. So therefore, when you look for a consolidated accounts, if there is anything called finance cost in P&L or finance income, that will be related to third party. That will be the part of your NG, aggregate net group interest expense and income. All right, this is only one calculation based on your consolidated account. Then there are few types of adjustment which you need to make it in order to make hardcore NG. That becomes too much, but as a quick brief outline, there are few upward adjustment, there are few downwards adjustment, depending on the nature of interest expenses. What are actual interest expenses? There may be the case. So in a UK tax perspective, say for example, if a company is building a factory, right? So a company borrowed money from bank or any other third party, right? So the time when they are constructing the building, the time when they're constructing the building or factory, whatever the interest they have paid till to that date when they finished constructing, for accounting purpose, that interest form part of capital expense. So say, for example, they spend £100,000 and on that £100,000, they pay £10,000 interest on the loan which they borrowed, right? So in accounts, you will put as an asset value of £110,000. And over the period of the building or a factory, they will depreciate it and claim an expense in a P&L on a yearly basis. But for tax purpose, HMRC allows, if you have borrowed the money in order to do some kind of capital expenditure and you paid interest on it, you can still get the deduction. So for tax purpose, you will get a deduction for that £10,000, the interest which you have paid by the time you were building that factory or something. All right. So when you are looking for a consolidated accounts, that interest expense won't be there, won't be in P&L, right? So for the calculation of NG, you need to make some kind of upward adjustments, some expenses which are not in the account, but you need to take into account, some expenses which are there, but you don't take into account, right? So those kind of expenses, you need to do a downward adjustment. After doing those upward adjustment and downward adjustment, you get NG. Sometime I will give a full lecture on what are the key adjustments in NG. But at the moment, I think that's more than enough to understand how to calculate NG. Now, what is QuenG? Qualifying net group interest expense. Now, QuenG is derived from NG. So now this again, you are looking for console account. First of all, you are looking for a group-wide console account. There are further adjustments from NG which are related to preference shares and some kind of share-related interest expenses which are recognized as a loan, but in reality they are preference shares, right? So those kind of adjustment you have to make it in order to make a QuenG. I don't want to go into further detail for a QuenG. This is how you will calculate QuenG. Now, what else? Group EBITDA. Group EBITDA. First, we said tax EBITDA. When you were looking for a tax EBITDA, you were looking only UK companies. While doing group EBITDA, you are looking again console account. Okay, simply group EBITDA, you just take earning, take in out interest, take out tax, take out depreciation, take out amortization. That gives you group EBITDA. I think that gives a brief outline of your CIR calculation. And that's it. Have a good day.